If you want a more balanced combination, so if you want to make sure that you have a reasonable amount of rental income and you also want to speculate and make some money on price appreciation, the goal then is to find properties in good locations that also meet the 1% rule or some other income measure. Welcome to the Real Estate and Financial Independence Podcast. I'm your host, Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. Whether you're a long-time listener or a first-time listener, thank you for being back for another episode. The title of today's episode is The 1% Rule, Quick Math for Positive Cash Flow Rental Properties. So if you've never heard of the 1% rule, it's a formula to help you quickly analyze a real estate deal. And so I'll explain exactly what it is, how you can use it, how you should not use it in this episode. If you are someone who knows what the 1% rule is, but you're a little skeptical about whether it's applicable in today's market, high prices, things going on, things changing, why should you even think about the 1% rule? I've got you covered there too. In this episode, it's an in-depth look at the 1% rule. Many of you may know that you can see in my background if you're watching on YouTube, I'm still in Spain. And so this fall, I've been sharing with you some of my best of Coach Carson podcast episodes. This is one of the most downloaded episodes of all times in the top 10. So I wanted to bring it back to you and share it with you. Later on in the fall, I'll be making some new content. But as I'm transitioning here, I'm learning Spanish, trying to become fluent in Spanish. I'm also writing a book called The Small and Mighty Investor. And so I'm taking a little bit of break from new content here on the podcast, but I will be back with more content later in the fall. But for now, I hope you enjoy the episode. Now, the 1% rule is an analysis tool used by a lot of real estate investors to quickly screen potential rental properties. Now, I've got to say up front, this is not the end-all, be-all of real estate analysis. I'm going to have some other episodes where I go into much more depth on some other tools that I like to use, like the cap rate, even using a spreadsheet. But I wanted to get this topic early on because I think it's very useful as a quick first pass at analyzing real estate. Something you can, after you listen to this, you can use it right away if you start looking at some properties today. And so in this article, I'm going to go into depth about what the 1% rule is, when to use it, and also when not to use it, and then explain why it can be helpful with some examples. I'm going to also address the 1% rule in higher priced markets. There are times when it makes sense to maybe break the rule. But there are also some risks to doing that. So I'll give you some examples of that. More than anything, the 1% rule is about a habit of income discipline. So income discipline. So it's a discipline when you buy investment properties. So it's a mindset of disciplining yourself to only buy real estate investments that meet a certain criteria of income production, whatever that is for you. And there's going to be some flexibility there, but it's about having criteria and then sticking to them when you're out analyzing investments. So let's get started. The first thing that I like to talk about is just what is the 1% rule. The basic benefit of investment real estate is its ability to produce rental income. There are other benefits, of course, but the number one, kind of the basic one, is the rental income that you can get from a property. So the 1% rule is a quick way to easily measure how well a rental property does that job of producing rental income. The 1% rule is simply a rule of thumb, and that says a rental property should meet the following criteria. So it should have the monthly rental income. So the rental income is whatever you can rent that property for. The 1% rule says that rental income should be equal to or greater than 1% of the purchase price. I'll say that again. The rental income for that property on a monthly basis, so let's say it was $1,000 per month, should be equal to or greater than 1% of the purchase price. So let me give you an example. According to the rule, a property with a total investment, so this total investment would be like your price of the property plus any upfront repairs that you had to spend. And so let's say that was $200,000. If you bought that property all in for $200,000, it should rent for $2,000 per month or more in order to meet the 1% rule. If the rent were only $1,500 per month and you spent $200,000, the $200,000 price would not meet that rule. Or if you had to pay $250,000 for a property that only rented for $2,000, it wouldn't meet the rule. See how that works? So you can also use the reverse of what I just did. You could say, instead of saying 1% of the purchase price, you could also say, I want to make sure my purchase price isn't any more than 100 times the monthly rent. So that would be the maximum you'd want to invest in that property if you met the 1% rule. So let's say, for example, you had a property that rented for $1,500 per month. So you could just quickly calculate that you could not pay any more than $150,000, because 100 times $1,500 per month equals $150,000. And I know some of you are not like math whizzes, and that's fine. But one of the reasons the 100% rule is really interesting is because the math is like really easy. Just a little trick here, a little kind of aside. If you have 1,500 per month, when you multiply it by 100, you just move that decimal place over 2 times. So just kind of picture it in your mind. 1,500, if you move the decimal place over 2 times, you've added 2 more zeros to that, and now you have $150,000. So pretty simple math, right? You could do that to almost any number. So hopefully that gives you kind of the basic idea of what the 1% rule is. But just remember, as I mentioned earlier, that it's the beginning of the story. The 1% rule is sort of the first step, and it also doesn't apply to all situations and all properties. So let's look at now when you should actually use the 1% rule. So I sort of alluded to it earlier, but the 1% rule is best used as a pre-screening tool. It's just a way to save time and to remain disciplined as an investor. This means you'll be using it very early in the process while you're looking for good investment purchases. For example, you could use it to quickly filter 20 listed properties that your real estate agent sends you. So first, you kind of scroll down that list of asking prices. So you can look at all the list of, this one's worth this much, this one's worth this much, and just kind of quickly scroll down in order to estimate what is 1% of each list price. So like I would be looking at it, and if it's $200,000, all right, does this property rent for $2,000? Okay, probably not. All right, this is $250,000. Does this property rent for $2,500? Probably not. All right, this one's listed for $125,000. Does it rent for $1,250? Yeah, maybe, or I'm close. And that's really what you're trying to do. You're just trying to get very close on that first pass, very quick math. And so and I mentioned using that trick earlier. That's the reason having some kind of moving the decimal place over is easy. You could either move the decimal place over twice. If you know the rent, move it over twice to the right to kind of figure out the max you can pay. And if you know the rent, you can move, or if you know the purchase price, you can do the opposite. You can say $200,000, move the decimal place over 2 times to the left. That means $2,000 per month. So back and forth, you're kind of doing that quick math to analyze it. So then after you have that 1% number, you compare that to the market rent for the property. So you're scrolling down that list of properties in this example. You are saying, all right, here's a $200,000 property. Does it rent for $2,000? And so that would be your question. You're hypothetical. You say, let me look at that. I think it does. And so then you could go do a little bit more homework and start doing a little more research on what the actual rent for that property is. And so, but because you've done that rough math and said, I think that's about right, then you can know out of these 20 properties you're looking at, maybe there are 2 or 3 that are worth your time to go dig into a little bit more. And so there are resources out there. Like I think one of my recommendations is when you're studying a market, you sort of create a farm area where you get to know the numbers, the rents, the prices, just almost intuitively, like the back of your hand. But early on, as a beginner, you're not going to know it that well. This is sort of the work of becoming an expert in your location. And so you're going to want to use some resources. There's some free ones out there that I would recommend just as a place to get started. You can go to places like Zillow.com. They have things like rent estimates, and they're not always 100% accurate. Like a lot of in my area, I'll look at properties that I already have, and I know that their rents is often a little bit high in my area, at least. Other areas it might be a little bit low, but that's a good place to start. Again, you're just looking at multiple places, sources of information. I also like to go to Zillow, and instead of just looking at the rent estimate, I look at the map of the area where they show similar listings, and you can look at similar rentals in the area. So you could just pull up the property you're interested in, look at the map. You can filter by just looking at rentals, and then you can look around and see, all right, here's another property renting for this much and this much, and see if they're similar, see which one's better or worse. So Zillow, good place to start. Craigslist is another one that in some markets it can be really good. A lot of people put their rentals on Craigslist. And then another one could be rent-o-meter. I mentioned these earlier again, but rent and then ometer.com. Rent-o-meter is another place where you can do some quick search and look up of what the rents are. Down the road, hopefully you'll get to the point where it's all pretty intuitive. And if you have properties in your market, you might say, this is a very similar rental to this other one I have in town. And so the 1% rule will be a very quick tool that you can just kind of use to compare it to one property to another. So that's the ideal situation of when to use the 1% rule. But now let's look at when not to use it. So after narrowing your list of properties and getting to those ones that actually have promise, I actually recommend moving beyond the 1% rule at that point. So that's when you start doing a little bit more in-depth analysis. So you're moving past the pre-screening and you're actually getting into the point where you're actually going to think about making an offer on the property and actually putting your best foot forward and telling them what you could pay for it. So I don't recommend using the 1% rule for that, to tell people what you're going to pay for it. And you might want to know why that is. Why is the 1% rule not the final word on deal analysis? And the main reason is that the 1% rule, just by definition, only uses the gross income of a property. And the gross means what you actually collect from the tenant, what you expect to collect from a tenant. But as you all know, that's not the bottom line of real estate investing. The bottom line is actually what's called the net income, or what's left over after you pay all your expenses. So the 1% rule is an approximation, a pre-screening, where you just take the total rent, but you're not taking into account the taxes, the insurance, the maintenance, the management. And so to really understand the numbers for a deal, you've got to understand the net cash flow from a property. So you have to deduct all the expenses. So all of those things I mentioned: management, vacancy, taxes, insurance, maintenance, capital expenses, mortgage payments. I'm not going to go into all those today. That'll be another episode where we talk about net operating income and cap rates and things like that. But just know for now that you would want to go into that next step of analysis when you're making an offer and you're actually putting your money into a property. 1% rule is good for pre-screening. It's not good as the final word. And so some of the ones I do use, the one I do, just a kind of a sneak preview, when I am analyzing a deal, I can still do it sort of on the back of a napkin if I need to. I don't have to have big fancy spreadsheets, but I do look at it sort of from a few different angles. I'll start with a 1% rule. I also like to set goals for things like a cap rate. And if you were interested in that, I have some articles on my website kind of going in depth on cap rates. I also look at net income after financing. So actually, how much income will I be making after I pay my mortgage as well as all my other expenses? And then a couple other ones that are important, looking at the value of the property, and am I getting it at a discount, and what are my risks in buying this property? So there's a few different angles you want to look at. There's no one end-all be-all formula that's going to tell you this is a good deal or not. You got to look at it from several different directions. But 1% rule is a good place to start. And so there are times when a property will meet the 1% rule and then not meet some of those follow-up analysis. So that's an important thing to know. This is sort of like a filtering process. And every step of the way, you are filtering to make sure it meets your criteria. And it is not abnormal to start with a big bucket of potential prospective investments to get down to one or two that actually meet your criteria. You're going to go through a lot of prospects before you actually get to that one or two that actually makes sense. And it's also, just another thing I want to mention about the 1% rule is I only use the 1% rule for certain types of properties. So in my case, it primarily makes sense for smaller residential units like houses, duplexes, triplexes, and quadplexes that are in A or B, maybe C+ neighborhoods. Listen to my other episode on how to pick a good location for a rental property, investment property on A, B, C, D neighborhoods. So typically A, B, or maybe C+ are where I'm looking, where the 1% rule would actually make sense. If I'm going kind of C-, or D, maybe even D, if I choose to buy D properties, 1% rule is off in my area at least. So it wouldn't make sense at all. So I'm going to use a different form of analysis. Maybe I use the 1.5% rule or the 2% rule in looking at those. And I'll also want to use some different analysis if I'm buying larger commercial properties, multi-unit buildings, And this really all just has to do with my goals for certain properties. There's certain properties I expect to get more income than I do other properties. The better location you're in, the better lower risk type of property you buy. So single family houses, duplexes, those kind of things in a nice residential neighborhood are really low risk properties. And you probably have to pay a little bit more and get a little bit less income to be able to buy those properties. But on the other hand, if you're buying in higher risk neighborhoods that are up and coming, but they're not there yet, or mobile homes or larger commercial properties, you're taking more risk and you typically expect a higher return for those. And so that's really what this is all about, is sort of just doing a proxy or an initial gauge of what your risk is in the property. Now, moving on, one of the most common challenges to the 1% rule, or the objections I get, is that it can't or shouldn't be used in higher price markets. So I'm in South Carolina. I'm in the southeast of the United States. Other people I know invest in Ohio and the Midwest and the Southeast. If you get up into bigger cities, the West Coast, parts of Canada, they're going to be very high price markets. And so what do you do there? And does the 1% rule even apply at all? So let's take a look at that situation a little bit more specifically in more detail. So the question I want to ask is the 1% rule even possible in some markets? So as you probably know, real estate investing is very local. It just depends on the town. It depends on the region. So a lot of things, even neighborhood to neighborhood, street to street, sometimes the real estate can change a lot. And the trends and numbers vary greatly depending on what, when you move from one location to another. And in some regions and big cities, it's nearly impossible to find properties that meet the 1% rule. So I just want to say that up front. For example, I used, when I was preparing this, I used Zillow local market reports to evaluate several high price markets or hot real estate markets. And this was as of actually earlier this year. I'm recording this in January 2019. I looked this up earlier in 2018, but they're still pretty similar at this point. But here are the results that I found. San Francisco, California, so just the city of San Francisco, has a median sales price of $1,289,000 and some change. So over 1.2 million, almost 1.3 million. So 1% of that, so if we're going to do kind of a quick analysis, would be $12,893. So you have to have almost $13,000 per month in rent to meet the 1% rule on the median sales house or property there. But what is the actual median rent in San Francisco? So the actual median rent is $4,285, according to Zillow's local market report. So $4,285 versus almost $13,000 is what we would hope it would be to meet the 1% rule. So, 3 times different, it's a third of what you would hope you would get. So that's not good, is it? Let's look at another one. Denver, Colorado, median sales price, $391,000 when I looked it up. So 1% of that would be $3,900, so almost $4,000 per month. The actual median rent is about $2,047 per month. So about half of what you would hope to get with the 1% rule. Let's look at one more market, Washington, D.C. Median sales price, $388,000. 1% of that would be $3,800. And the actual median rent, just over $2,100. So all of these, the actual median rent is a lot less than what you would hope for to get 1% of that median price. So in the case of Denver and Washington, D.C., you'd have to buy an average home at almost half of its value to meet the 1% rule. You have to get a 50% discount in order to make that work. And what do I mean by that? If the actual rent in Denver, for example, is $2,000 per month and the median sales price is almost $400,000, you need to buy it for $200,000 in order to meet the 1% rule. That's 50% of what the median price is. And in San Francisco, you'd have to buy it at almost 1/3 of its value. So these are all kind of ridiculous hypotheticals, right? You're not going to typically buy at 50% or 33%. So buying at that big of a discount is not normal. So what are your options? Number one, you can go buy in other areas. You could go outside of those markets completely, or you could try to find lower price locations within that market. The other option is you can stay in those markets and you can just lower your criteria. For example, maybe you have a 0.5% rule instead of a 1% rule. So many investors choose option number one, going to a completely different market, and they just simply buy properties long distance. A friend of mine named Rich Carey, he writes a blog called richonmoney.com. He's done that for years. Initially he lived in Washington, D.C. He later moved abroad to Korea with his job in the military, and he now owns a portfolio of free and clear rental properties in Montgomery, Alabama. So a long distance, has a team there, built a team there, but he doesn't live local. He lives in a high price market. Probably when he comes back to the U.S., he plans to live in a high price market, and he just invests elsewhere. So that is a common approach. They're good and bad about that. There's challenges. That's something we can talk about more in some other episodes. But the other option, others may choose option number 2 that I mentioned before, and just lower the criteria for how much income a rental property needs to produce. So this could still work if you make money in other ways, like price appreciation. But before you go that route, so before you go and just buy a property based on how much it's going to go up in value, let me go to my next topic, and explain why the 1% rule and income discipline in general matter as an investor. So why do they matter? So real estate is just a tool to accomplish your financial goals. So when you step back from all of this analysis and numbers, the basic is think about why you're buying this property. You are buying it as a tool to accomplish something financially for yourself. So you invest your savings, you invest your time, you invest your energy, and you hope on the other end of all that, the property pays you back much more money than you invested. And that happens over time. Then you can use that money to do what's important to you. So to use it to achieve financial independence, use it to pay off debt, use it to do what matters in your life, which is the theme of this podcast and my website. So how exactly does real estate do that? Primarily, real estate does that in one of 2 ways. Number 1, the real estate can pay you rental income. So that's the net spendable income that you can be used to save, to invest in other properties, to pay down debt, to pay for your lifestyle. That's a big part of what I'm doing now in my lifestyle is we've built up a certain number of rental properties, and we're now living off of that rental income. So I'm living off part of it, but we also reinvest part of it to grow and do other things. So that's number 1. I mentioned that in the very beginning. Rental income is the primary reason a lot of us invest in real estate. But number 2, in some cases, equally or more important, there's price appreciation. So this is the growth of your property value and of your equity and of your wealth. So your net worth is getting bigger as the price goes up, or as your equity goes up. And this can happen either because you bought the property at a discounted price up front. So maybe you bought it for $150,000 and it was worth $200,000. So you bought equity up front, or it could be because it increases in price after you purchase it. So later on, why is this important? You can harvest that equity. So whether you bought it at a discount or whether it went up in value or both, you can harvest that equity by selling the property, by refinancing it, and you can use it to do other things. You can use it to invest, you can use it to pay off debt, whatever the case might be. So as a smart investor, you should take advantage of both of these profit centers, both the rental income and the price appreciation, if you want to achieve a better result. But of those 2, rental income and price appreciation, rental income is the most straightforward. I love buying properties at a discount or adding value to increase their price, but these processes are inherently more speculative and risky. At best, they take more time and energy in order to capitalize on them than it is just collecting some rent. And at worst, the profits you get from increasing the price are on paper, and they can disappear before you can take advantage of them, because real estate markets and the prices tend to go up and down a lot. They're not quite as volatile as the stock market prices, but they both go up over time, but they're very volatile in the short run. Rents, on the other hand, do go up and down a little bit as well, but they're much more stable than prices. So this is why I personally set goals for income. So whether that's the 1% rule, other formulas like cap rates and net income, when I'm buying a property up front. These are kind of like gauges on a dashboard of a car. These are the formulas that tell you how well that property is going to do in its job of producing rental income. So the 1% rule, again, is just a proxy or a quick approximation for that, how well that investment is doing its job. if you choose to lower your expectations, and so this is kind of a long rant on saying what's the risk of lowering your expectations and say, I'm going to buy a property that doesn't meet the 1% rule. So if you lower your expectations for rental income, and so you didn't meet the 1% rule or some other criteria, you've got to make up for that shortfall somewhere else. And that's going to be that you have to make sure you're comfortable that it's going to be made up, or that you're comfortable just accepting a lower return on your money. So let's look at a couple of examples. I've gone into a lot of kind of the what and the when and when it's not going to work. So let's try to bring all of this concept home by talking about an example of a property that does meet the 1% rule. Let's say that you buy a duplex for $100,000. So this price includes your purchase price plus all your upfront costs. So closing costs, repairs, that sort of thing. So that's your all-in investment, $100,000. But then to buy this property, you invest $20,000 of your own cash. So you make a down payment of $20,000, and then you borrow $80,000 from a bank, from a mortgage company at 5% interest for 30 years. So your payment on that mortgage is about $430 per month. All right, so with me so far. So the total rent or the gross rent for the property is going to be $1,000 per month. Because remember, it meets the 1% rule. You have a $100,000 purchase, $1,000 per month, so 1%. It's operating expenses. So this is like all your things that you pay after you rent the property. So your management, maintenance, kind of an allowance for vacancy in case it goes empty every once in a while, which it does. Things tend to do. Your taxes, your insurance, things like that. Let's just say that that's $400 per month. So you collect $1,000 per month. You allocate for expenses, $400 per month. So you're going to have about $600 per month left over. So let's take a look at what that means for you as a rental owner. And if I were sitting there, and I actually have written an article on this before, and so I had like a spreadsheet or a little table showing you what this is, but I'll just try to explain it verbally here. So if you had $1,000 per month and you subtracted your $400 in expenses, you'd have $600 per month left over in what's called your net operating income. So $600 per month. That's before paying your mortgage payment. All right, that's step one. Step two is you deduct your mortgage payment, which remember was about $430 per month. So $600 per month minus $430 means you have your net income after paying your financing. So this is what's left over before you have to, for everything except for paying your income taxes, which we're not going to get into today. That's $170 per month. Or on a yearly basis, that's a little bit over $2,000 per year. So $2,040 per year. So not every property that's going to meet the 1% rule will end up with those same kind of results. But in this case, your net operating income, so that remember that was before we paid our mortgage payment, on a monthly basis was $600 and on a yearly basis is $7,200. So if you didn't have any mortgage, if you just owned that property free and clear, you'd make over $7,000 per year, $7,200. And so if you're going to do a cap rate, which I'm getting a little ahead of myself, but I just want to kind of touch on these concepts so that when you hear them later on, you'll be familiar with them. Your cap rate on this property would be about 7.2%. That's $7,200 divided by your purchase of $100,000. But I'm just going to leave that there for now. But the bottom line here that you're going to put in your pocket before income taxes will be over $2,000 per year. And remember, you invested $20,000 down. That was your down payment. So that's how much cash you had in this property. And you get $2,000, over $2,000 per year back. So that's pretty simple math there too, right? That's about 10% return, cash on cash return. $2,000 in, or $20,000 you invested, you get $2,000 back in year one. So about 10% of your money. So what can you do with about $2,000 per year? So you could put it back in the bank and save it for your next purchase, for example. You could also apply it to the debt, either on this property, or if you like to do one of my favorite tools, a rental debt snowball. You could use this and kind of concentrate it with several other rental properties and try to pay off one of your mortgages really fast on one of your other properties. So that's one way to kind of get, once you've built up a portfolio of properties, how to get them free and clear. So those are some ideas on what you can do, why it's important to have that cash flow. So now let's look at a property that does not meet the 1% rule and just kind of see what the numbers look like in that case. And so in this example, the income is going to equal about 0.5% of the total purchase price. So instead of the 1% rule, we're going to go with the 0.5% rule, which might be realistic for some of you and some of the properties you're looking at. So let's look at what those numbers would be. So in this example, let's say you buy a duplex for $200,000. And again, the price includes your purchase price and all your other costs. And you invest 20% down again of your own cash. So that in this case, 20% of $200,000 is $40,000. So what that means is you have to borrow the rest of it. So you have to borrow $160,000, and we're just going to assume you do that at 5% interest for 30 years. So that's a payment of about $859 per month. All right, so I'll repeat those numbers again just to help you as we're going through this. But the gross rent for this property, because remember we're meeting the 0.5% rule, the gross rent for the property is $1,000 per month. You bought it for $200,000, it rents for $1,000. It does not meet the 1% rule. And so its operating expenses are going to be similar to our last property. They're going to be $400 per month. So you're going to net the exact same thing. The rental income on this property is going to be exactly the same, except for you paid more for it, therefore you have a little bit higher mortgage payment. And so let's see what that means. So you have the same net rent, $1,000 per month or $12,000 per year. Your expenses are $400 per month, which means your net operating income before your mortgage is $600 per month or $7,200 per year. So, but once you deduct your mortgage payment, you have $600 left over. You have a mortgage payment of $859. This still has to go out the door. So you have a negative cash flow of $259 per month, or on a yearly basis, you'd have negative $3,108 per year. So in this case, your net operating income is, as I mentioned earlier, is $7,200, but because the purchase price was twice as much, your cap rate is also not as good. So you'd have a 3.6% cap rate, and the way I got that was $7,200 divided by $200,000 purchase price. But the bottom line income from your rental, so and again, this is before income taxes, will be negative for the year, negative $3,108. This means you'll have to feed the property cash from another source. And where is that other source? The source would be your personal savings, a job salary, or positive cash flow from another rental. In other words, this property can't stand up on its own. You're going to have to feed it for a while. And maybe that's okay. There are certain situations where a little negative cash flow is not the end of the world. If you have a plan in the future for how it's going to get better, that could be. But it's not a positive experience in my experience of real estate investing, having to have negative cash flow. So you don't want that to be a long-term reality. So does that automatically mean that any non-1% rule property is going to make negative cash flow and be a bad deal? Not always. There are times when breaking the rule can make sense. So let's take a look at how a property that doesn't meet the 1% rule could still make sense eventually. So in other words, how do you break the 1% rule and still make money? So with that last property that did not meet the 1% rule, the principal on the mortgage actually is something we didn't talk about. When you make that $859 mortgage payment, you're actually reducing the mortgage by about $2,400 per year in that first year. So on paper, at least, the negative result is not as bad as I made it out to be. So you had negative cash flow, but your actual loss, kind of moving behind financially, was only about $700 per year. So you had $3,100 in negative cash flow, and you had about $2,400 in principal pay down. So it's kind of like you're putting money into a savings account, but you still have a little bit of a loss, $700 per year. But let's say that it gets even better. Let's say that property appreciates by 3% that same year. So that could make it the deal a little bit better, even better yet. So a 3% price increase on your purchase, on the price of $200,000, is $6,000 per year. So again, on paper, you would actually be ahead by just over $5,200. So because you lost $700, but then you made $6,000 on appreciation, that's where I got $5,300. You'd be ahead by about $5,300. So on an investment, if you made a $40,000 down payment and you have about a $5,300 positive return, that's actually about a 13% return on your down payment. Not bad, right? And that really gets to the essence of how most investors can still make money on an investment property when it doesn't meet the 1% rule. In essence, they must depend more heavily on price appreciation than income. But there's a downside. There's a downside to that, is that, as I said earlier in the article, price appreciation is more speculative of a source of profit in real estate. That return you make, even if it's a good return, is simply on paper until you actually sell the property or refinance it. So unlike rental income, which you put in the bank right now, like you get that income, it's a more solid current source of income. Price appreciation is something you have to do a couple extra steps to get to. And with real estate, which is fairly illiquid, meaning it's not easy to sell, it's not something you can do right away. It takes a little bit of time to capitalize on that price appreciation. So that doesn't mean that speculative is a bad word necessarily. In fact, it's been one of the most profitable sources on many of my deals in a couple different ways. One way, I've had a lot of properties, rental properties, and also flip properties where I've done something to the property, where we've fixed it up, where we've added a bedroom, where we've converted a basement to a rental unit, where we've increased the rents, all sorts of things that have increased the value of the property by our entrepreneurship and our effort. So those have been ways we've increased the value of our property. We've also benefited, and many of you might have as well, from just holding a rental property in a good location. So if you have a good location where things tend to get better over time, then the price of your property could go up and up and up, and the rents of your property could go up over time. So over the long run, it could actually be a very good source, and it might be your biggest source of profits over the long run. But here's what I want to get back to is that if you have a negative cash flow up front, you're going to have to feed that property in the short run in order to get to those more speculative profits on the back end. And if that makes sense for you, if you can afford to do some of that negative cash flow in the short run to get to that on the back end, then that could be a good investment. You have to have more cash and more staying power to make that happen. So the primary issue here is, and this is kind of wrapping things up a little bit, is the primary issue is how much on each deal that you look at, how much will you depend on speculation and how much will you depend on rental income? Because those are both sources of profit. So if you buy properties that don't meet the 1% rule or any other kind of base measure of income, then you've made your decision. You're depending more on speculation for your profits. And if you're comfortable with that and you have a plan to make it happen, go for it. This is all about just kind of being open-eyed and aware of what you're doing as an investor. There's no right or wrong there. But if you want a more balanced combination, so if you want to make sure that you have a reasonable amount of rental income and you also want to speculate and make some money on price appreciation, then the goal then is to find properties in good locations that also meet the 1% rule or some other income measure. That's sort of the bottom line. So my final thoughts here, I hope this kind of deep dive into the 1% rule and what it is, when to use it, when not to use it, how to use it in higher price markets or whether you can use it in higher price markets. I hope that's all been helpful for you. It's been a quick look at this simple real estate investing tool. And my goal with this episode and really everything I'm doing here at Coach Carson and this podcast is that I hope you can apply this and use it. So the main thing that I hope you can take away is go practice this. Go see if properties in your location meet the 1% rule. And if they don't, start studying how you will make money on that property. Because the philosophy here that I hope you'll take away is that having a discipline with your investment analysis, and particularly with your income in this case, is what leads to successful investing down the road. And so the 1% rule is just one of several tools that you can use to maintain your income discipline when you're making purchases. And in the end, that each little property you have, each little piece of real estate is just like a little business. And that little business should pay you money. And so that's the discipline I'm trying to encourage myself, but also all of us to have. The more rental income your little business pays you, the sooner you'll reach your goals, the sooner you'll reach financial independence and do a lot of the other fun stuff that you got into real estate to do in the first place. If you like the show, I'd like to invite you to subscribe to my free email newsletter at coachcarson.com/REI Toolkit. In addition to weekly updates, articles, and behind-the-scenes tips from me, my email newsletter subscribers get my real estate investing toolkit, which includes a property closing checklist that I actually use when I buy properties, a real estate deal worksheet, a tenant screening criteria checklist, and other spreadsheets and goodies that will help you on your journey to financial independence using real estate. You can get it all for free at coachcarson.com/REI Toolkit. I also want to take this time to thank some people behind the scenes who make this podcast possible each and every week. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who helps me behind the scenes and is my partner here at Coach Carson. And of course, thank you to all of you, the listeners of this show who make everything possible. This show exists for you. It exists because of you. And I really appreciate you being here for another episode. Everything I've shared with you in this episode has been for general education purposes. I've not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. See you next time.